Follow this dollar. You're about to deposit it at one of America's biggest banks. Here's what most people never realize. You're not storing that dollar. You're lending it. A deposit is a loan from you to the bank. And for that loan, three of the largest banks in the country will pay you 0.01%. On $10,000, that's $1 a year. Not a typo, $1. Now walk to the other window of the same building and ask to borrow money back. On the credit card they mailed you, the average new card offer, nearly 24%. Same bank, same customer, same dollars. One number is microscopic, one is massive, and the distance between them is one of the most profitable arrangements in the history of business. Today, we follow your money through that building, and by the end, you'll know exactly how to stand on the right side of the spread. Let's kill the comforting myth first. Your savings account is not a vault with your name on it. The moment money lands in the account, it becomes the bank's working capital. They lend it out, invest it, put it to work. Legally, what you own is a claim, a promise the bank owes you money back. You are, functionally, the bank's lender. So the only real question is, what interest does your borrower pay you? At the giants, the banks with stadium names and skyscraper logos, the answer is 0.01%. The national average across all banks is barely better, about 0.4. Meanwhile, online banks, same federal insurance, same dollars, pay around 4%, 400 times more. Hold that thought, because the size of that gap isn't an accident. It's a bet the big banks are making, and the bet is about you. Now the other side of the counter. The average interest rate across all American credit cards, 21%. On accounts actually carrying a balance, 21.5%. And if you apply for a new card today, the average offer is 23.79. Multiply those rates by a nation of balances, and you get the number that should be on billboards. $253 billion a year in credit card interest and fees. Every year. That's the most expensive consumer debt cycle in modern American history, bigger than the GDP of most countries, flowing quietly from household budgets into bank income statements. Put the two windows together and the machine reveals itself. The bank borrows your money at 0.01 and lends it back to you and your neighbors at 24. For every dollar of interest they pay you, they're positioned to collect over 2,000 going the other way. Banks call the difference the net interest margin. You're allowed to call it what it looks like. And here's the detail that stings. Those are often the same person. The average interest-carrying card balance costs about $1,300 a year, while that same household savings earns $1. Same bank. Net flow, $1,300, one direction. In any textbook market, a 400x price gap gets destroyed by competition overnight. So why has this one survived for years? Because the big banks aren't betting on rates, they're betting on inertia, and the bet pays. 82% of Americans don't use a high-yield savings account. 8 in 10 savers voluntarily accept $1 instead of $400. When researchers ask why, the top answer, from 45%, is wanting a branch nearby. A building they might visit once a year is priced, invisibly, at hundreds of dollars annually. Bankers have a term for money that stays put no matter how badly it's paid: sticky deposits. Your inertia is literally on their balance sheet as an asset. The 0.01% isn't an oversight they'd fix if someone pointed it out. It's a price, precisely calibrated to what people will tolerate without moving. The online banks paying 4% aren't charities, by the way. They just don't carry 10,000 marble lobbies. No branches, less overhead, and the savings gets handed to depositors as yield. Because a new bank's only weapon against inertia is a number big enough to wake you up. 400 times is the wake-up price. Let's make it personal with a real comparison. $10,000 of typical emergency fund parked for 2 years. At a big bank, it earns about $2. At an online high-yield account over the same stretch, about $750 more. Identical money, identical federal insurance. The only difference was a 20-minute decision. Per year, that's $1 versus roughly $400. The difference between a coffee and a flight. And remember the inflation series from earlier in the Illusion Files. With prices rising around 4%, money earning 0.01 isn't resting. It's shrinking, losing purchasing power every single day, at almost exactly the rate a high-yield account would have preserved it. Same ice cube. One half in the sun, one half insulated. That's the entire choice. 3 moves to cross the spread, from the side that pays to the side that gets paid. Move 1. Open a high-yield savings account for your emergency fund and savings. Around 4% is available right now from established, federally insured online banks. Check 2 things and you're safe. FDIC insurance, or NCUA for credit unions, and no monthly fees. Keep your old checking for daily life if you like the branch. The point isn't divorcing your bank. It's refusing to let your savings subsidize their marble. Move 2. If you carry a card balance, that's a guaranteed negative 24% investment. Nothing in finance legally beats paying it off. Attack the highest APR balance first while paying minimums on the rest. The avalanche method. Every $100 you clear at 24% earns you more than any savings account on earth. Move 3. The mindset shift. From now on, every dollar you hold is a loan to somebody, so act like a lender. Keep checking accounts lean. A month of expenses, no more. Savings in high yield. Longer-term cash in treasury bills or money market funds if rates beat your bank. None of this is exotic. It's just asking the question the bank hopes you never ask. What am I being paid? The spread will always exist. The only variable is which side of it you live on. 0.01 on your savings, 24 on your borrowing, $253 billion a year in the gap. The machine runs on one fuel, people not looking. You just looked. Next on the illusion files, the products in your grocery cart are shrinking, legally, deliberately, and in ways designed so you won't notice. We'll show you exactly where to look. Subscribe and see you there.